Welcome back to Investor Thoughts. This is episode number 3, Stock Market Investing for Beginners. This is recorded in February 2022. A quick disclaimer, this is not financial advice. Okay, as Albert Einstein said, if you can't explain it to a 6-year-old, you don't understand it yourself. So, if you see any content online or you listen to any podcasts and people are overcomplicating this process, they probably don't understand it themselves, or they are overcomplicating it so they can sell you some courses or some books or some other stuff that they can make money from, because they probably make more money from that than they do from actually investing. Okay, we're going to cover a lot today, so please pay attention. First, basics. What is the stock market? Okay, the stock market is simply a place where you can buy shares in public companies, for example, Apple, Google, Microsoft, etc. There's thousands of them. There is stock markets in most countries, the UK, the US, France, Germany. They all have their own markets, but the most predominant market is the US. It becomes a concentration of companies for many reasons, but that is typically where most people invest. That's where I invest, and I expect where you will likely invest. It's also the stock market it's the only stock market that's produced great returns for over 150 years. Most other stock markets haven't really produced hardly any return. Okay, what is a company? Because if you're buying shares in a company, what even is a company? A company is simply a legal entity that holds inside of it employees, bank accounts, intellectual property, databases, physical assets, investments. That's all that it is. The same in most countries. And companies were originated many years ago as simply a way for the wealthy to wrap up assets into an entity that could be efficient for taxes. That was the original reason for it. So when you are buying shares on a stock market, you are buying them in a legal entity. Each company has a number of shares, and those shares can be split at times, which will mean you increase the number of shares, or they can be a reverse split, which means you reduce the number of shares. Ultimately, this doesn't change anything about the value of people's investments. It's just a number in a database. So, for example, if the market cap of Tesla is 1 trillion and roughly there is 1 billion shares available, then the share price is 1,000 per share. So when you hear people referring to share price and market capitalization, this is the difference. The market cap is just the share price times the number of shares. You would be very surprised the number of people, even popular people on YouTube and such, that don't even know this definition. So it's very important to understand. So when you look at a company and you see a share price of $10 and then you see a share price of $1,000, it doesn't mean one is cheaper than the other. What matters is the market capitalization. So if you Google any company, you'll see the number of shares. It will appear in the results, and you'll see the market cap. And the market cap is the share price times the number of shares. So think in market cap. That is the best way to think. Okay, what about price? Who sets the price? So if I'm buying a Tesla share for $1,000, who set that price? No one technically set the price. When the company was first launched onto the stock market, there was a set price. But immediately what happens is that when people are selling the shares, the price goes down. When people are buying the shares, the price is going up. It's a free market system. It's all completely digital now, so it's just a software that runs each of these indexes, these exchanges, sorry. So you've got the NASDAQ, you've got the NYSE, that you can just think of them as a place that you connect to where you can buy some shares in a company. So it's completely free market. No one's setting the price. Okay, what should you buy? What should you invest into? Well, if you want the lowest but safest returns, you simply buy the indexes. It doesn't mean complicated indexes. It just means something like the S&P 500. There is a bunch of companies that wrap these up. The best is Vanguard. They come in different forms in each country wherever you're investing, but roughly speaking, you look for the S&P 500, you're pretty safe. The expense ratio that these indexes charge does matter. So typically going with Vanguard's the best. They're just the cheapest. This basically holds a share in 500 of the top companies in the United States. This is pretty much the most superior way of investing for most people, because the successful companies go up in that list, so they create high returns, and then the companies that are dying, they go down. So you kind of get somewhere in the middle. And this has produced an annual return since 1871, to be clear, of 7 to 10% per year. That's better than property. That is better than any other investment. Now, you will have years where it goes up 20% and years it goes down 30%. But if you never sell, it doesn't matter. What is the annual return over time? I covered this in previous videos. Okay, in episode number 2, I did explain how you can retire in 10 years investing into something else. You can go check out that episode if you haven't. Here we're just talking about the indexes. You can do any kind of research you like, and you can invest into any company you want. It's up to you. You get to decide. But we'll cover now how you need to think about that. You have to forget that it's a stock market. You just have to think of them as assets. So, what are all these complicated metrics? P ratio, beta, forward P, dividend yield. You'll find a million numbers. It's all bullshit. It doesn't matter. Okay? Forget about them. What matters is this. Can you value the company? How do you value the company? Well, the value of a company really is just all of the future profits. People will say earnings, it's the same thing. All of the profits over its lifetime. Now, what is the lifetime? When you think the company will die and go bankrupt, basically. So typically people think in 100 years, or some think in 30 years for the company. And then you take all that money and you discount it every year backwards to today, which basically gives you there's something that is referred to as present value. Please do not get this confused with price. Price is different to value. Price is what you pay, value is what you get. So obviously what you want to be doing is buying things that you think are more valuable than they're priced at. Simple, right? It's really that simple with investing. Don't let anyone else confuse you otherwise. Okay, we'll speed up here because there's still a lot more to cover. So here's where the PE ratio comes in. I just said, it doesn't matter. PE ratio is just a simple method of saying what a company is priced at. So roughly speaking, the stock market, if you look on average, prices companies at between 10 to 20 times their profits. So if a company produces 100 billion in profit per year, it's likely valued at 1 to 2 trillion, 10 to 20 times. And that's assuming little growth, but what if a company's growing at 100% a year? It's doubling every year, or 50% a year. Roughly speaking, you can pay relative growth rate to the P ratio, meaning like if the company's growing at 100% a year, you can probably pay 100 times earnings for that company. So if it's growing, this is a crazy scenario, but if the company's producing 100 billion in profit and is growing at 100% a year, probably wouldn't happen. But anyway, you can probably pay 10 billion for that company as a market cap. So then all you do is you take the number of shares, we already discussed that, you divide it by the market cap. That's what you think the future share price could be. It's always much easier to simply look at a company and analyze what you think it will be doing in decades, at minimum 10 to 20 years, and then apply some kind of PE ratio at the time. For example, in my scenario, I expect Tesla to be producing over $1 trillion in profit per year by 2030, 2035, I'm not sure exactly. And I assume it's still going to be growing at 30 to 40% per year. So I expect the company will be priced around a 30 to 40 trillion market cap based on that. And today it's currently, you can buy shares in the company at a 1 trillion market cap. So thus, it's a 30 to 40x potential upside. Okay, what about dividends? Okay, avoid dividend companies like the plague, okay? Although these companies in many cases are safe investments, they are paying dividends because they cannot figure out what to do with the money to get a return on it, okay? When you get to a certain size, the job of the CEO of the company is really an investment role. So he's taking whatever the profits are and the cash he has and he's putting them into growing the business. But typically what happens is they can't come up with any good ideas. So they pay dividends. That's what a dividend company is. It's not, that means that the value of the shares that you own are not going to grow that fast, are they? If they can't figure out how to grow the company and they're paying you out the dividends, it's probably just going to grow at an average rate of 5 to 10% a year. Many people do not understand this concept. They will talk about, you'll find a ton of channels that talk about dividends. They simply don't look at it this way. So they focus on cash flow. I mean, how much dividends are they making each month from their investments? Versus what matters, as I said before in previous videos, the total return. Like, of your portfolio, what is the amount it is growing per year? And looking at that over time. That is the only number that matters. You know, I would rather grow my portfolio 40% per year than 5% per year. If you understand compounding, which I suggest you to go Google and to really, really look at and really understand compounding. It's hard for the human brain to fully appreciate compounding. Think of the recent pandemic we had. You'll realize how silly dividend stock investing is. Okay, again, so what should you buy? I can't make that decision for you. It depends on what you're trying to achieve. You know, do you want to save and retire early, or are you rich already? If you're the former, you need to invest every penny you have to get the compounding machine running, and you need to grow your base at a high but obviously safe rate. For me, the best possible investment today is Tesla, but if you watched the last episode, you already know that. Investing does not need to be complicated, okay? Stocks and shares are simply a piece of a business. It's just ownership in the business. Think of these businesses as private businesses. Don't think of them as public businesses. Don't think of them as the stock market. Just think of them as assets. Would you be happy to own them for the rest of your life? If not, don't invest into them. Okay, one last thing. Do not invest based on hype and what other people think. All investing is value investing, meaning you're buying something for less than you think it's worth, which means you need to understand what it's worth. You need to think about that yourself. And you don't need to be a professor. You don't need to be a mathematician to calculate that. You should be able to do it on a napkin. It should be really that simple. You know, what is the business going to be producing in profit? What are the revenues? What are the costs? What do I think a reasonable value the company will, what do I think is a reasonable valuation for the company at that point, and what is the price today and what's the difference? Simple as that. One other thing. Do not watch and listen to financial news. Do all your own research. Do not pay attention to daily price movement. This is for losers, okay? You're not a loser. You're now a cold, calculating investor. So act like one. Okay, if you found this episode helpful, useful, please like it and subscribe. This is just the beginning, so this really helps get it out to more people. Please do that right now. Comment as well if you have the time. That also pushes it out to more people. Thank you for listening, and I'll see you next time.